So tonight we're going to look at how to form effective joint venture working relationships, because I know that this is one area that sometimes gets a bit tricky when we're looking at HMOs. How do we manage the relationship? How do we make sure that we have the right parameters in place? A bit like many other partnerships, you know, whether it be marriage or any other business partnership, I think joint ventures can have the ability to go quite seriously wrong, actually, because people have different expectations. And I think when you have different expectations and you don't elucidate them, you don't make explicit what is implicit, it can lead to a lot of confusion. I wonder if you've ever had a situation where you felt, I wish I could get out of this partnership or this relationship. If you have, you'll know exactly what I'm talking about. So tonight is all about how to form effective joint venture relationships. And do feel free to message me, to put something in the chat panel if you've got any questions or queries, or if there's anything that I say and you don't understand it, or there's anything you disagree with, please feel free to let me know. So to give you a bit of background to my story in regard to joint ventures. So I, as you probably might know, I had a few single buy-to-lets. I had about 5 single buy-to-let properties, and they were going okay, but I discovered HMOs. And this picture here is of my 7-bed HMO in Crewe on Gainsborough Road. And I had just started working on this second HMO when I unfortunately had the experience of running out of money. And I realized how difficult it was to run out of money mid-project. So, is that somebody joining us? Yes, I think it is somebody joining us. Great. Please say hi, whoever's just joined us. It'd be really great to know who is online. I think we've got Charmaine. Yeah, and both the Janes. Fantastic, great. So just say hi in the chat panel, guys, so I just know you're here and that you can hear me okay. So I ran out of money halfway through my second HMO, and it was a really difficult time. It was a really difficult time because I felt like I'd let Andy down. I felt I let the boys down. And yet I also knew that if I could get this over the line, what a difference it would make to our lifestyle. We would have much better income, and potentially I could give up my fairly well paid but rather monotonous job teaching in the university. So this is me standing in the loft extension that we did at Gainsborough Road, and starting to think about how was I going to raise the finance for this next part of the build, because it was this part of the build that caused me so many headaches, because I had not properly evaluated how much money I would need, and this then meant that I needed more money than I realized. So here I am, kind of looking, you know, sort of rather, you know, looking as if I know what I'm doing, basically. Looking through the looking through the windows. Yes, oh yes, that cellotex looks absolutely perfect. Thinking I knew what I was talking about, and clearly I didn't. I was very inexperienced. And I hit what you might have sometimes hit yourself, is a crossroads. Now, when you hit a crossroads, it's very demoralizing, because you have a big plan in your mind. You think that you can achieve X, Y, and Z, and you suddenly realize that you can't do this on your own. Now, tonight, I don't want to just enable you to think about joint ventures as being something which is just about money, because actually it's a lot more than that. But it's about having a partner, a person you're working with, who has more than you have, and maybe you have more than they have. So together you form an effective relationship. I hope that makes sense. But what I found was that I was working very much on my own. Andy was working full time, so he couldn't really be involved in the property. And I was trying to run my property business by myself, all alone. And I just could not see where my blind spots were. I couldn't see what I needed, and I couldn't predict it. And so it caused me to go into a bit of a spiral, a bit of a downward spiral. Now, fortunately, I managed to raise some finance to finish that project, and I then developed a lot more HMOs. And along the way, I found a partner. I found a business partner called Mark. Now, the great thing about Mark was that he had some experience in property as well. He was equally keen and willing as I was to develop HMOs, but he had some money. So what I didn't have, which was money, he did have. But what I had was experience, which he didn't have. And also, I suppose I had a bit of youth on my side, ha ha ha, she says. But I certainly had a focus. I certainly knew my area. I knew what I could get in my area. And I was getting returns nothing like Mark could get down in his area of Worcester. So this was a really effective partnership because I had something to bring and he had something to bring. And he saw in me something which probably I didn't see in myself. And I probably saw something in him that he didn't see in himself, because as well as having money, he also had time, he had some experience, and he had a really good network as well. So since September 2013, we were able to expand the portfolio. And you can see from the slide, there's a number of different HMOs on that slide, all ones that we have bought either with joint venture partners or with investor finance. 90% of our portfolio is owned with investor finance, perhaps not 90, maybe 70% actually. But we have a lot of investor finance that we've used to create passive income. So it's a really powerful way to grow your business. And I think if I was going to say to anybody starting on HMOs today, one of the things that you should be focusing on very, very early on is how do you work with other people? Because property can be a very lonely game. It's very individualistic. You tend to buy property in your own name for your own family, for your own welfare. But actually, as we know, the banks are tightening up their requirements for lending. It's getting harder and harder to get seed finance for property. It's getting harder to get refinance for property. HMOs are one of those funny classes of property where they're residential, but they're kind of semi-commercial as well. So banks are getting more and more funny about what they do and don't do, and what they will and won't do in terms of lending. Now, if you're going to maintain momentum in your business, you're going to have to get some outside funding. Now, again, please let me reiterate, it might be that you have a perfect JV partner who doesn't have any money of their own. That's okay. But I really believe that two are better than one in this game. And the two of you can go out and find finance. After all, there's double the time when there's two of you together. So that's what we've done since September. Bringing me financial freedom. And I would say that without working with Mark, it wasn't just that he had money to bring into the partnership, but he also helped me to learn and understand and think about property differently. So, you know, it was, could definitely say it was a win-win situation for both of us. And by the time I got to about £6,000 net income per month, that was the time when I was able to give up my job, and he gave up his job, and we felt secure enough to be able to do that. And that was the figure that we needed. And had we not had that, we couldn't have done that. So when you work with a joint venture partner, you will double your time, you'll double your money. If they are a joint venture partner who also has money, that's even better. It allows you to buy each and every property deal that you find, because you've got money sitting in the bank that's ready to buy each and every property deal. If you had enough time and money to be able to assess and evaluate deals, wouldn't that make your life so much easier? What about the ability to confidently network with people who had much more experience because you had money or knowledge or time, which of course we all have, but in different varying measures? It gives you a stronger negotiating position. And having a business partner or a joint venture partner also allows you to have somebody that you can kind of, you know, bat your ideas against, that you can have a sounding board for your ideas that you don't when you're on your own. So do you think this would help you? Message me in the chat panel. Tell me, do you think that If you had a pipeline of money, if you had knowledge and experience perhaps brought by a joint venture partner, if you had more time, do you think this could help you grow faster? Just let me know in the chat panel. All you need to do is type, yes, Wendy. Thank you. Brilliant, absolutely brilliant. So let's have a think in this webinar. What do you need and how do you choose that right person? Because you'll probably find there'll be lots of people who could be your joint venture partner, but how do you make sure they're going to work for you? And when I say work for you, I mean make sure that they're right for you. The core problem that many of us face is this: no money. So that means we can't make offers easily. That means we can't negotiate easily. That means we can't be creative in our deals, probably because we don't know how to be creative. It means we can't buy at auction. Now, auctions are great places for discounted properties, but if you haven't got cash, you can't easily do that. I mean, there are ways, but they're more risky. It destroys your confidence. It slows your progress and it stops you reaching your goals. So having a pipeline of money, whether it's through a joint venture partner, stroke investor, or through your partnership that goes to find that money, part of that key part of being a property investor is finding the money. Key. And in the system, the 5-step system, this comes under funding it. So joint ventures, joint venture partnerships, you'll find a lot more information in the Google Drive under funding it in the webinar, in the mentoring system. Interesting, Charmaine said she lost a house that should yield £46,000 annually because of a lack of money. Right, so there, pain. It's painful, isn't it, if we haven't got money? And yet we know there's loads of money in the world. So where is it? It's obviously flowing to somebody else. So why do investors or even joint venture partners need you? Well, if you've got a joint venture partner that has some money, remember they probably have money in the bank and the bank interests are very, very low and you can give them a much better return. And if you form a partnership, a joint venture, you can agree on what that return is going to be. You might have heard the phrase that Robert Kiyosaki says, savers are losers, which I think is very dramatic, is our Robert. But in other words, people are losing money because of inflation. It is eroding the value of their savings. So they are actually losing money. We know that pensions are getting worse. There's legislation galore. So people need help to navigate these different routes into HMOs, into property. And there's lots of people who are losing heart. Most of these, of course, are individual, single entrepreneurs who are probably investing in their own name. They're not investing in a limited company. They may be doing it for 10 or 15 years, but they don't realize that great opportunities lie ahead for those of us who stick with this and make it happen. So I really do believe that in time, as we go through this cycle, there are going to be fantastic opportunities for people who are ready. And I do believe that when you work with somebody else of an equal mindset, with an equal values to you, similar values to you, you can create really powerful partnerships. This slide just shows you how the UK house price index has performed compared to the FTSE 100 stock market index. Now you can see that the FTSE 100 has a lot more fluctuations than the housing market, but actually they're very, very similar in the end. The difference, of course, with property is you can leverage it. This is the power of property, is that you don't have to use all your own money to buy it, whereas in the stocks and shares market, you do. So we can see and this chart clearly shows inflation at work, because it shows the value of assets going up. And if you look at it compared to, say, 1992 to 2016, tremendous growth in asset values and asset prices, which is why, of course, a lot of people want to get into property and property investing. This is a friend of mine called Jackie, and we have a small joint venture together. We do projects from time to time. And in fact, I'm due to speak to her tomorrow because she's got a pot of money that she wants to invest with me. And together we agree on the 4 steps of that project, and I'm going to go through those 4 steps with you in a moment. But for her, it's been absolutely great win-win, because I've used her money to invest in property, I've made money for myself, and she's made money for herself as well. And she's also been able to create a small portfolio of properties for her children to inherit later on in her life and in their lives. But what's the difference between a joint venture agreement or arrangement and when you work with an investor? Well, generally, a joint venture is longer. It's a longer term arrangement. So this is something just worth bearing in mind, that it's not going to be so much for short term. And if it is, oh, Jane, sorry, thank you very much for your question. I'll come back to you in a moment. Normally, a JV is also more in depth in terms of the structure. You need to think carefully about how you're going to structure that joint venture, because the clue is in the title. It's a joint venture. You're doing this together. You're probably going to develop more of a portfolio than just a project. It's about a relationship with that person long term. So unlike the investor, where it might be more transactional, you might be just doing 1 or 2 projects, it's actually probably got a longer term aim to it. So there's definitely a layer here which is about the identity of the business, about your brand, and about how you're going to grow and structure that business moving forward. So let's say you have 3 to 5 properties together. Well, who's going to be managing them? What are the arrangements in place for ensuring, for example, that the bookkeeping is done or that the accounts get done? Roles and responsibilities are more tricky, but also more important in a JV partnership. Whereas with an investor, it's often more short term, it's more of a simple structure, you're on a project by project base, and the money is the goal. So what money you get out of it at the end is the goal. But with a JV, it's about the relationship as much as it is about the money. Do please feel free to ask some questions about those, about that slide as well. If you've got some questions about how you're wondering about whether you should look for a joint venture partner, or whether you're looking for an investor, and what you think would work best for you, please feel free to comment on that. Okay, so Jane Curran has sent me a good question. If it was your project, Wendy, that you had already started, how did you sort the project out? Did you get Mark to angel the money to you to finish it? No, I actually found another investor, Jane, for the end of that HMO. I was able to borrow £30,000 on a 7% interest rate for 5 years, and I repaid the capital at the same time. So as soon as the HMO was completed, the investor started to get their money back, and after 5 years, that loan was repaid. And because the property was making me about £1,600 a month profit, even though I was then paying, I think, about £400 a month or maybe £500 a month for the loan, I still made a really good profit even after paying for the investor. So that was great. And now that property, actually, I think we've got 1 room vacant at the moment, but now it makes about £1,400 to £1,500 profit per month. So it's a very profitable business. But just that 1 property is really excellent. Okay. So what are investors looking for? And when I say investors, I also mean joint venture partners, but we're going to go into a little bit more detail about how it's a slightly different when you're looking at joint venture partners as opposed to investors. And Partha, I'll come to your question about how do you find investors a bit later on. Really good question, thank you. So there's 4 things that you need to bear in mind when you are working with anybody in terms of a project, whether they are lending you the money, whether you are going into a joint venture with them, or whatever structure even if it's a transactional deal where you're doing the work and you're getting paid for it. Commitment, communication, clear purpose, and clarity of entry and exit. So what do I mean by that? So when we talk about commitment, now, obviously, what we need to be doing is to be showing to our investors or our joint venture partners that we're committed to this course of action. You know, there's nothing worse than meeting somebody, and I've met many of these people at property networking events, they come up to you, and in fact I've had many people pitch to me, would you like to come into a joint venture with me, would you like to work with me? But you know, I'm looking for somebody who's got a bit of credibility, and it doesn't need I'm not looking for somebody who's maybe got lots of experience. I think that's a bit of a myth, but I'm looking for somebody who will show to me that they've thought about the project, they've thought about the risks, they've thought about the downsides, they've put themselves in my shoes, they understand why I might have second thoughts or doubts about it, they've thought about how the project might turn out and what the downsides might be. They're committed to making it work, they're committed to seeing it through. And when it comes to a JV, this is even more critical. I think it's so important that you're both focused on the same thing in the same direction at the same time. There's no point working with somebody who secretly wants to do commercial conversions or land developments or planning gain or you know, some other property strategy, when what you want to focus on is getting 5 cash flowing HMOs under your belt. You've got to be focused on the same thing. You need to understand what strategy you're aiming for, and that you're going to focus and you're committed to that direction of travel. We've talked a little bit about RACI roles before. So a RACI chart is a chart that determines who is ultimately responsible, so that's what the R stands for in RACI. So who's responsible for an action taking place? Who is accountable for an action taking place? Who needs to be consulted for an action taking place, and who needs to be informed when an action takes place? And having that RACI chart is quite important to actually look at that fairly early on in the joint venture partnership, because part of the commitment here is understanding what your roles and responsibilities are and who's going to do what. Because if you don't have that clarified at the beginning, it can lead into all sorts of different areas of problem later on. I also think it's a good idea to think about your wealth dynamic profile. So this is Roger Hamilton's wealth dynamic profiles, and or if you're not going to use wealth dynamic profiles, you could use something like maybe Myers-Briggs, or you could do something like maybe the what's it called? There's another one which is the DISC profile. Because I think understanding yourself and understanding your partner is crucial to be able to communicate well. And we'll come on to communication in a moment. Yeah, that's very true, Charmaine. I think there is certainly, as you go through a project, you'll learn what those different roles are. But I think that even the most inexperienced person would understand that somebody has to buy the property, and all those steps to buying the property. Somebody has to manage the builder for the refurb. Somebody has to get the tenants or find the agent. Somebody probably has to refinance it. I mean, I think most people in this group have got enough basic education in property to understand that is the sort of cycle that you go through. That's the process you go through when you're buying and refurbing a property. So even at that level, I think you could do some of that the RACI stuff, but it will become more detailed and more granular as you go through the project. So you're absolutely right. But I think that commitment to looking at those roles early on will really help you to see how you can benefit each other. Because, you know, one of the things about the joint venture partnership is that it's supposed to benefit both of you. And if you're working with somebody who's too much like you might find that actually there is little benefit in the partnership. So it's really worth considering who brings what skills to the table and how are they going to benefit the partnership. And it's worth spending some time on this. So when I met Mark, I met him in May, and we spent probably June, July, 3 months clarifying what we were going to do for our joint venture partnership. It took us 3 months to formulate Best Nest, and it was only about September, October time 2013 where we actually set up our LLP. And in between, we've probably met 4 or 5 times. I met his wife, he met Andy, we talked, he came to Crewe, I went down to Worcester. We talked about how we would do this, how we would do that. We didn't rush it. And I see a lot of people rushing joint ventures and then finding that, you know, actually it hasn't worked out as well as they would like. And in which case it might be better to set up more of an investor relationship. But a joint venture is really longer term, and it's more committed. So Jane, really good question. Are we looking for someone with opposite Myers-Briggs profile to work with, or just looking for understanding of the other person? Well, I think it's a bit of both, to be honest. I think if you're a Myers-Briggs person who is a P, ESFP, let's say, so you're a perceiving person, you're probably not going to be very fixated on deadlines and complete to finishing and, you know, getting stuff done. You're probably good at seeing the bigger picture. You're probably a very big visionary. You're probably very creative, and you may be very good with people. Whereas if your partner is a J, ESFJ, judging, they like to get things done. They like to get things finished. They like to get things tied up. They like to know where they are. They like certainty. And it's about understanding that you work differently. It's about knowing that your joint venture partner, if they are somebody who likes deadlines and certainty and plans, you need to be aware of that. But they also need to be aware of the fact that maybe you're not so into that. So for example, today I had a call with my friend Jackie booked in for 4 o'clock because we want to talk about our next project that we're going to do together. And I was a bit busy earlier on today. So I phoned her to say, when can we speak today? And she said, oh, I'm free after 3. So I messaged her and said, great, that's cool. Could I do it after 4? Because I had something else I needed to deal with between 3 and 4. Could I speak to her at 4 o'clock? Fine. So I phoned her at 4 o'clock and it went straight to voicemail. And I messaged her and I said, you know, it'd be great to speak to you. But at 4:30, I had to go and take Luke to his new job. He's working in a bar. So I then, about 20 past 4, Jackie messaged me saying, I'm free now. So I then had to message her and say, I'm really sorry, but I've only got 10 minutes. It's not really long enough. Let's rearrange for tomorrow. Now, I know Jackie is terrible with time. I mean, if anyone thought I was terrible at time, you have not met my friend Jackie. She's about 1,000 times worse. She's always late. She always underestimates how long things take. And she's terrible with punctuality. But you see, I know that about her. And I still think she's a great person to work with. I love her. And she's got a lot of great ideas. But it's about understanding her. It's about knowing, you know, Wendy, don't get frustrated if she's late. I mean, to be honest, I don't really get frustrated when she's late anyway, because time for me is a rather funny kind of Western construct. But however, let's not get into that. But the point is, she understands me and I understand her. So it's really easy to work together because we just don't rub each other up the wrong way. And I think, Partha, what you're saying there in the chat panel is really true, that you need to, you know, it would be lovely, it'd be wonderful to find someone with the same passion and dedication, but maybe actually somebody who could also give you something that you don't always have, you know, because we all have strengths, don't we? But we all have weaknesses too. And a joint venture partner the right person can actually provide something that you don't naturally have yourself, which is why learning about who you are, what you're good at, what your strengths are, doing the wealth dynamics profile test, for example, can really help you to understand where you will thrive in the business, where you will flow in your business. Second step is communication. Now, really, it doesn't matter what wealth dynamics profile you are, communication is vital to any partnership to make it work. And often partnerships fail because of a lack of communication. And if there isn't enough communication on a regular enough basis to share ideas, thoughts, worries, fears, discomfort, unhappiness, that relationship is not being given the right food that it needs to grow. So communication is critical to the relationship. And it's what I would call creating a rhythm. So it's a business partnership. We have to accept that. However, I think that create a regular time and date to speak with your potential or your actual joint venture partner. So now that Mark and I have got a portfolio of properties up and running, and I do with Jackie as well, Mark and I speak at least once a month. So every month we have about an hour and a half on the phone. We go through each property, we analyse the profit and loss, we have a look at all the different issues that we've had, we look at potential other projects that we might want to do, we catch up with one another, and it's a really good meeting. But of course, that's because we now have a steady stream of income from those properties and we have a steady portfolio. When you're starting off, you may well have to speak to each other every day. And I know that with certain, new burgeoning relationships, having a regular time once a day when you speak may well be what you need to get going with it, because it needs that kind of energy to get it started. I think you have to be clear with yourself and you have to be clear with your JV partner what you want. And this takes a bit of self-reflection and a bit of time, because it's very easy to think all I want is money. But actually, I suspect it's more than that. You may want someone who could be a sounding board for you, who maybe has business experience that you don't have. You maybe want someone who could do some of the admin for you, because that's something that's overwhelming for you. And maybe you're not particularly strong on admin and don't really enjoy it very much. Maybe you need somebody who's actually quite good at the technical side of things, who doesn't mind learning technicalities and using the computer system and dealing in the detail with the building control officer, because they're a technical kind of person. They quite enjoy that. But they need someone like you who's got the vision and the ideas for branding and the finish. So be clear about what it is you like doing and what you want out of the partnership. I think early on, it's again, before you waste any time with somebody who might not be quite right for you, discuss your hopes, your fears, your doubts, the opportunities as you see them, the worries you have, the challenges that you're facing, because it's very likely that the other person has got similar but maybe slightly different thoughts on those areas. And if you can't do that from the get-go, from the start, if you can't be vulnerable and open with somebody from the start, it's going to be very hard 6 months down the line when you're facing problems to be really clear and honest with them. Now, friendships can often burgeon into joint venture partnerships and can be very successful. But friendships can also create difficulties for joint venture partnerships, because you're no longer just friends, you're also in a business partnership. So while there needs to be some sharing of personal realities and personal feelings, I also think that there is an important element to this, which is about creating a business interaction with your joint venture partner. So what I'd suggest is you have KPIs early on, key performance indicators. How many viewings have been undertaken? How many phone calls have been made? How many people have been spoken to? How many business meetings or networking meetings have gone to? How many estate agents have been phoned up? How many letters have been written? And these are all the things that are the, if you like, the lifeblood of your property business. Partha, you say you're scared to mix friendship and business unless it's the right person. And I think that's a really interesting comment, actually, because I think there's lots of people who probably feel like that. And of course, these are stages of the development of a joint venture partnership. You won't necessarily meet somebody at a property networking event and immediately, go out for a drink with them and tell them all your hopes and fears. I think that could just scare them off a little bit. However, I do think it's important, even in a business relationship, to share your real feelings. I've seen 4 or 5 of my friends, my good friends, have very painful breakups from their business partner because the two of them never sat down and honestly shared with each other how they felt the business was going. And, there is a phrase that says that cash covers all problems in a business. And when the cash flow is good, very often people are happy. But what happens when the cash flow isn't so good? What happens when you have a project that is running out of money? What happens when you have a builder who isn't delivering? You need to both be firmly behind your strategy, behind your operations, pushing forward together, not pulling away from each other. And developing that deeper bond, that deeper relationship, that deeper emotional connection is the way to do that. So vulnerability is actually important for relationships, business relationships to work. If you're not able to be open, and of course it takes time, it takes trust, and it takes consistency. But that's a key part really of forming a good joint venture. Charmaine, you're absolutely right. You need to like them and need to be able to have them in your house. And, you know, they do say that we talked about this on Saturday, the 3 key areas are knowing, liking, and trusting. And if you know, like, and trust someone, you're much more likely to want to work with them. But if you don't, you'll be wary about it. So, okay, a couple of other suggestions. Set some ground rules early on. So if you're going to have a meeting, say, okay, let's set some ground rules for our meetings. So we meet for an hour. We maybe each have half an hour to talk, or we have an agenda at the beginning of the meeting, and at the end of the meeting we each say how we felt about the meeting. We don't let interruptions get in the way of our meeting. You know, and then there might be other things as well that you want to put into those ground rules about how you operate the partnership. Let's, for example, say, what about spouses? What if your spouse is a bit uneasy about this joint venture relationship? Okay, what do we do about that? Or what about an investor who you meet, who wants to invest with you, but doesn't know your joint venture partner? Can you go off and do separate projects? Do you have to do everything together as a company, or can you do things separately? You know, it's getting all of these things on the table early on, so there are no misunderstandings, and so the expectations are really clear. And I think that you need to also be able to keep each other accountable. And this is hard. This is really hard in a relationship, because, you know, we as human beings, we're not very comfortable, are we, at keeping each other accountable for things. And there's kind of a nice way to do it and a nasty way to do it. But I think that if you both agree early on, you know, we've got to keep each other accountable to the things we're going to do. That doesn't mean to say we're not going to support one another, but it just means that we're going to say, do you know, what was the problem? Why didn't you get that done? What happened? Because that is how you're going to grow, isn't it? And ultimately, this is about growth of your income, growth of your business, growth of you as a business person. Any questions on that, by the way, before we move on to clear purpose? Yes, I'll come on to Jane. I'll come on to the structure in a moment, how you should structure a JV, because there are 2 or 3 different structures that you can use. So I'll talk about that in a little while. Okay, great. So clear purpose. So I think when you're looking at working with an investor, they want to know a clear purpose. It's good if you're you know, familiar with all the facts and figures at your fingertips, that you've done some deal analysis on the project, that you've got some idea about the outcome, the return. When it comes to a joint venture, there are other questions you need to ask about the clear purpose of the joint venture. What is the length of time of this joint venture? You know, that's a really important question, isn't it? Are you saying you're going to be in joint venturing with this person till you die? Or are you going to be joint venturing with them till you retire? Or are you going to joint venture for the next 2 years and see how it goes and evaluate it? Or, you know, what's the plan? What's the plan? You know, it's up to the 2 of you, isn't it, to decide what the length of time is. It might be a good idea to say, let's trial it first for a couple of years and then assess it. And again, if at the beginning you set your KPIs, it makes it much easier to assess it a little bit down the track. So Jane Curran, this was, I think, asked the question. Jane Vincent, sorry, Jane. What happened with Mark and myself was that we set up an LLP as a trial, because we knew that an LLP was much easier to run than a limited company. So we set up an LLP to try working together and see if it would work out. And we bought 2 properties, 2 HMOs in the LLP. We then decided that because we did want to grow and we worked well together, we would start a limited company. And that's when we started Best Nest Limited. Now that worked really well, because effectively by starting in an LLP, we were kind of starting in our own names, and there wasn't really a commitment as directors, and all the other costs that go with running that kind of a business. But it meant that we could also find out, were we good to work together? Could we bring those skills? When the rubber hit the road and we were right in the middle of a project and things were tough and difficult, could we still keep calm, get on with one another, and not fall out the whole time? And yes, we could. And Mark was really good. He was really reasonable. He was very helpful. He came up from time to time to help me with managing the projects. I did most of the day-to-day work. And we got through it. We got through it unscathed. And in fact, Mark used to have an apartment in Turkey. And, he said, oh, if you guys ever want to go and use our apartment in Turkey, you can go and use it anytime. And we did. We stayed in his apartment, and we, as I say, we speak regularly. I know his family. He knows my family. So, we've got a friendship there. It's not a particularly close friendship, but it's more than just a business acquaintance. We have quite a strong business relationship together. Absolutely, Charmaine. An LLP would be a very good structure if someone owned a property and you want to develop it together. It would save you having to become a limited company. The only problem there you have is tax, of course. You have to look at the tax implications on that. But I think LLPs are not used very much in property, and they are quite useful ways of binding you together under a partnership agreement, but without it being in a limited company. And it can be much easier then to get finance as well. Okay, so a few other things about your purpose within the JV. Think about your roles and responsibilities, who's going to do what, when, and how. Now, you might use the racy format for that, which is good, but just discuss it together. Who's going to do different parts of this? Who's going to do this? Who's going to do that? Who's good at this part? Who's not so good at this? Which areas of expertise or experience are you lacking as a partnership? Because it might be that one of the things you're lacking as a partnership is money. You might both be very committed to developing a property portfolio, but neither of you has any money. Well, that's okay. It just means that one of you or both of you are going to have to be finding the money. And actually, sometimes doing it with somebody else, there's a real sense of camaraderie when you're both facing the same challenge or the same issue. And when you speak to each other and you have your daily or your weekly calls, or your calls twice a week, who have you been speaking to? How did that networking meeting go? What did you find out about this? Have you had any response to such and such an email that you sent out? It's great to have somebody else who's interested in the same business that you're interested in and is jointly focused on the outcomes of that business. So it might be that, as I say, you have similar areas of experience, but you lack one particular area that you have to find that will fit into your business. Deciding how you'll measure success. So in 2 years' time, what will be a success KPI? What will be a success criteria? How will you both go, do you know what? So far, this JV has been really successful. What are the measures of that? And it's important that you review and assess those measures, because as we all know, life changes, doesn't it? Things change. The mortgage market could change. The buying market could change. There could suddenly be a great finance option on auction property, and suddenly you think, actually, we were going to be buying direct to vendor, but now let's do some more stuff on auctions. Things change. So don't be scared to change with them, but think about how you're going to measure that and when you're going to review and assess it. And again, I think this is where openness and honesty comes in, to say, I'm not terribly happy about this, or could we look at this, or could we do something like this, please? And then the fourth area that investors are looking for, but I think this is really good learning for your joint venture partnerships as well, is clarity of entry and exit. So with a JV, how are you going to decide when to execute the start date of your partnership? So you need to decide when you actually enter the partnership. So this means having the paperwork lined up and ready to go. If you're going to start, whether it's an LLP or a limited company or one of the other structures I'm going to talk about, there's certain pieces of paperwork that you need to work through first before you start the partnership, before you launch it. And it's really important that you get the paperwork done first before you launch the partnership, because the danger is that you launch the partnership and then you do the paperwork and then you go, it's not going to work because of X, Y, and Z. So you've got to get that out of the way first. But equally, you need to think about the exit. So are you going to own property together for the rest of your lives? What happens if one of you dies? What happens if one of you wants to sell up? What happens if one of you wants to move abroad? You've got to think about all these potential challenges or changes that might occur along the way. And maybe do a bit of a brainstorm, make a whole long list of what ifs, so that you can then think about how you're going to mitigate them. It may sound like quite a lot of work that needs to be done, but I would say it pays off in the end. It really pays off in the end. The third thing is that you and your joint venture partner consult with key people in their lives. So their spouse, their mentor, their trusted friend, because what you want is somebody who's got the support of their spouse to work with you, particularly if you're, opposite sexes. And certainly I think, when Mark and I first started working together, not so much Andy, but Nikki, who's Mark's wife, raised a couple of eyebrows, particularly when he had to come and stay up in our neck of the woods when we were doing projects, and he would come and stay over a couple of nights at a time so that we could be on site 2 or 3 days in a row. And, you can understand it. And I understood it. And I said to him, look, I need to come down and meet Nikki. You can see there's absolutely no threat. Mark, I'm really sorry. You're a really nice guy, but frankly, if you're the last man on earth, I still wouldn't be interested. I don't want to be rude to you, but you're not my type. I think he took it the right way. But I just wasn't, there was no interest in that department whatsoever. But we got on well as business partners, and that's how we formulated our friendship, and that's how we formulated our business. But it's awkward, but you have to have those conversations. I have to say to him, how does Nikki feel about this? And he would say to me, how does Andy feel about this? Because they are key people around you. And if they're not happy about it, you're going to face a real lot of problems as you go on. So that's just a little bit of advice. The other thing is to risk assess the partnership. And I would suggest you do this individually and then together. So what are the areas that could be risky because of the lack of skills, experience, or knowledge that you bring to the partnership? So which areas don't you have knowledge, experience, and skills in, and that you either need to find or you just need to identify you're lacking? It could be time, actually. Time could be one of them. Time could be one of the areas that you realize is lacking, because neither of you have time. You're both really busy. But there are answers to that. You can use the skills of other people. You can use the time of other people. Okay. Any questions, any thoughts, any feedback so far? Fire away at me, peeps. Let me know what you're thinking. Perhaps you've all gone to sleep. Maybe I've just sent you to sleep with my stories of romantic intrigue and mystery. Good. Rob's awake. That's brilliant. Rob's woken up. That's all right, Rob. Good to have you. So Charmaine, I think, there's no harm in finding out a little bit about them personally, their background, their history. Yeah, of course, it's not like dating, and there'll be a different feel to the relationship. So remember, context. Context is really important. So if you want a business meeting, set it in a business setting. Wear something that is business-like. Have a bit of an agenda. Sit down and say, look, these are the things I'd like to discuss with you, if that's okay. make it a bit more formal. But even though it's formal, it doesn't have to be impersonal. Find out a bit about the person, talk about what you would like to achieve and what you think, and ask them what they would like to achieve. So I think those are all the questions. And it's a bit like, you know, I say this sometimes, my analogy is like a long hotel corridor. You know, some of these really long hotels that you go into where they have massive long corridors upstairs, and they've got sort of rooms from 3,400 through to sort of 8,900. Massive. In America, they've got them, massive, bigger hotels. And you kind of go through this endless series of double doors. And for me, working with an investor or a joint venture partnership can feel a little bit like you get through one double door and then you've got a little bit more journeying to do before you get to the next double doors, and then you go through the next set of double doors and you've got a bit more journeying to do. And it takes time. It takes time. So at the moment, for example, I'm having a conversation with a guy that that contacted me about HMOs probably 6 weeks ago. I spoke to him. We exchanged some emails. Then we were going to meet in London, and he couldn't make the time that I could make, so we didn't manage to do that. Then I was at the Property Super Conference 2 weeks ago, and he texted me saying, "Are you here?" And of course I was there, which was an amazing coincidence. So we managed to grab a coffee in the back room, and we probably stood and chatted for about an hour and a half. And it was all about HMOs and you know, how we make money in HMOs and how we could help him. And as the conversation went on, you know, I said to him, "So what do you do for a job?" And he told me what I did for a job. And I said, "Are you married? You got children?" "Yep, got 2 children. My wife does this, blah, blah, blah." "And you're in London?" "Yeah, I'm based in London. I live here." "So how long have you been doing this job for then?" So we just started to kind of have that conversation. So it was personal, but it was also helping me to kind of put him in some context. And then, of course, he said to me, "What about you, Wendy? Have you got children?" So I told him about the boys and about Andy. And it was one-to-one, friendly, open, but we both were clear that the aim was we wanted to make money out of HMOs. He wants financial freedom, the possibility to leave his job, and he wants to work with somebody who's doing it and already has a successful track record in doing it. So great, there's a really good mix there. We haven't finalized or formalized anything yet. We've had some email exchanges, we've had a one-to-one conversation, and we're having a Zoom call next week. And this time I'm going to, Andy will be on the Zoom call as well. And the two of us with him will have a further conversation. How do we take it the next steps? He's filled out my property investor profile sheet, so I know he's really interested, he's committed. So the next step will be probably to talk through the process of how do we form something together? What's he looking for? What are we looking for? How can we make this work? So, you know, we're through one set of double doors, but we're not through the last set of double doors yet. So Partha, that's absolutely fine. Investor finance is something you've got to learn to do as well as JVs, so it's fine. Okay, so a really good question, Rob. How do you close out the conversation? I think you've got to, as in any good sales, I think you have got to close it. I think you've got to say, "Listen, are we in or are we not? Are we going to take the leap of faith or are we not?" And it might be that some of these areas are not quite clear in his brain. So the clarity of entry and exit, it could be that's what's bothering him. That there's something that he's thinking, but what if this? What if that? And that's why I think you need to do a brain dump of the what ifs, so that you and your joint venture partner are both really clear about what if one of you gets cold feet. What if one of you decides you want to exit the relationship? And you may have to take some legal advice on that as well. So we have a joint venture partnership agreement, which is in the drive that you can use, and it clearly states, you know, what are the steps. So what is the penalty clause for exiting the relationship early, for example? There needs to be a penalty because you may put a lot of eggs in that basket. So, you know, you shouldn't be losing out. Okay, that's brilliant, Jane. Have a great evening. Lovely to have you. Okay, Charmaine, set up limited company and one partner wants out. Could you have a written partnership they have to offer to sell their share in the company to you? Yes, absolutely. So we'll come to structures in a minute, but that's one of the challenges you have with a limited company, is that you are both a director and a shareholder really from day one. And if one partner wants out, depending on how long the business has been running, there will be a value to their share. So they should sell that share if you're willing to buy it to you. Valuing that is a tricky business. Now there is a website that you can go to get your business valued. Oh dear, I can't remember what it's called now. I've got some notes somewhere for an event I went to, and they told me about how to value a business. So if you're interested in that, Charmaine, let me know, and I'll get the detail to you. Yeah, but I think, Rob, so your question is, it's more about getting them not to procrastinate and decide. There's a reason why they're procrastinating. There's something there that's holding them back from saying yes. Now, it could be that you haven't actually just asked them. It could be that you haven't said, right, I would like to push forward on this. I really want us to make a decision. What's your answer? And that will help them to go, all right, Rob, yeah, let's do it. Or it will help them to go, I'm still not sure. And then you can say, okay, let's talk about that. What is it that you're unsure about? What are the uncertainties for you here? Let's really talk about the risk, because risk is often something that we make really big in our brains. And when we talk about it, it's actually just not true, is it? Somebody once said, we all have a tendency to think catastrophically. So the minute our bank account balance is low, catastrophe, we're going to die. It's going to be horrendous because we haven't got any money left. Well, no, it's not that bad. You haven't got any money in your bank account at the moment. You might have a bit of savings. You can get another client, get a loan from a friend. There's ways through it. Yes, you may have to be very careful for the next few weeks to build up your cash flow again. Yes, you need to learn from this and realize that you need to put some money in savings so you don't have this problem again. But we all go into catastrophe thinking, and maybe your friend has gone into, but what if this, what if that, what if it all collapses, what if it all goes terribly wrong? And he can't tell you about that. He sort of feels that he can't pop your bubble. I think if you would say to him, listen, Bob, whatever his name is, what are you thinking? What's holding you back from this? What's the real issue? Please tell me. I promise I won't be offended. If it's to do with me, it's really helpful for me, because feedback is the breakfast of champions. And I want to know, if I can be better as a potential partner. If it's not me, if it's something else to do with the partnership, what is it about the partnership that bothers you, or the deals, or the projects? Let's discuss it. And if there's a way in which we can mitigate those things, let's do that early on. And that might be the way he thinks. And he might be a very cautious person and be like that the whole time you're working together. In which case, you also need to be aware of that and think, do I want to work with somebody like this? Because if they're very slow at making the decision about the partnership, are they also going to be very slow about choosing which properties to buy, or how to do the refurb, or which builders to choose? It's something to just be aware of, I suppose. Okay, so as you probably heard me say, it's when you run out of your own money that your learning really begins. And it's actually not just about running out of your own money. It's when you run out of your own resources. So resources are, of course, bigger than money. It's when you run out of your own mindset. It's when you run out of your own ability to do stuff that you suddenly realize that actually partnerships are vital for growth in a business. So how do you find investors or JV partners? Well, it might be somebody who's already an investor and is themselves finding it a bit tough, finding it a bit slow going, and they need someone with your verve and energy to push them forward. But they might equally bring something very valuable to a partnership, which might be an already well-running property portfolio, and they might be willing to put in some capital into a new venture with you. Friends and family, people who you know and you trust and you like. I'd be careful with family. I've heard a number of issues with family partnerships, and got to make sure they're the right person. And I would definitely suggest doing the wealth dynamics profile to get that right person. Other business contacts you have, people that you meet networking, or other business contacts that you have, they can often be JV partners because they've got the right skills, the right attributes, the right mindset. And other property people. I mean, what's fantastic for me is that even within our fairly small mentoring group, we've got people already doing JVs together. I mean, that's fantastic. And I'm going to talk about one of those in a moment. So there's lots of places. It's about having the right open mind to think about, what do you need? What would you ideally like? And who could you do with in your business? And the three areas, of course, to really drill down into are the time, money, and knowledge stroke experience factors. Who's got them? Who could offer them? And what can you bring to that partnership? So when we think about structuring our joint ventures, we can have an LLP. So that's a limited liability partnership. It's counted in tax purposes as being the same as if you own property in your own name. If there's obviously two of you who are in that partnership, it'll be split 50-50. So you may need to get some tax advice just to make sure that this doesn't have a detrimental effect on your tax return. Having said that, if you are both putting money into the LLP, for the first couple of years, you won't have any income tax to pay, very little income tax to pay, because you will be probably drawing back the capital that you originally invested. So for the first couple of years, those what are called losses can actually be used to offset your income. So it's a very effective way of structuring a director's loan. You could start off with a limited company, but there are more complications to that because you are then both directors and shareholders. And if one of you decides you don't want to carry on, then you must have a partnership agreement in place. And you should do this from the get-go, which says that one of the retiring directors must sell their shares to the other one. They must make an offer to the other director to sell the shares, because I've seen it in companies where one director resigns but keeps their hold of their share because there was no partnership agreement in place. Yes, Charmaine, absolutely. You can set up an LLP, which you have for that time to develop the property, and then a limited company or somebody else will buy the property before it's rented out, or you can move it actually into a limited company. Again, there's things you can do with LLPs that you can't always do with limited companies. So it is a very nice flexible structure that you can use. And I do think if you're starting, you might be working with somebody as an investor, but actually you both get on really well, you both develop good projects, you're both happy about the direction. Maybe the next step is a limited company. You don't have to, it's a bit like living together before you get married. An LLP. You could do a joint venture agreement between two companies. So your business, your limited company, and their limited company could form a joint venture between the two limited companies. So that's again another way to do it. That means that you don't have the complete, you're not sort of completely getting into bed one another without having your own separate identity and your own business identity. You could just form a partnership, which is effectively a sole trading partnership, which is a JV agreement between two people. I wouldn't really recommend that. I think that's a little bit risky. And I think that an LLP gives you a bit more security. Charmaine, you may have to pay stamp duty to move the limited property to the limited company. Sorry, the LLP to the limited company. It depends who the directors are of the limited company. You won't necessarily have to pay stamp duty. There is something called incorporation relief, which means you don't have to do that. You need to think about share capital, as we mentioned earlier on, if there are shares. Rob's question: when do you have to have a bank account? Well, from the age of about 5, I would say. Oh, right. Do you mean with regards to your joint venture? Okay, so sorry. Yes, thank you. So I would say that you probably want to be setting up a bank account about just after you set up all the partnership agreements. So once you've got those signed and legally you are now in a partnership together, then I would set up a bank account. I Would I do it before? No, I wouldn't really. And unless, again, I suppose I can't say for certain. It depends on the relationship, Rob. Actually, the bottom line is it depends on the relationship. So I have a joint bank account with my friend Jackie. I've known Jackie for 30 years. I'm a godmother to her daughter. You know, Jackie's not going anywhere. You know, we completely implicitly trust each other. We still do have a written agreement though. We still do have a deed of trust on a couple of properties that I own that she has a share in, and vice versa. So we do still have written paperwork between us. But with her, I probably would open it fairly soon to start getting the ball rolling on the money. But it all depends on how you're going to structure the business as well. Co-signatory though on any bank account, so neither can do stuff alone. Yes, you could. Well, again, it all depends, Charmaine. I have to say, it all depends. With Rob, who's in Hong Kong, it might be easier for him to have a bank account where, you know, either he or his business partner, who might be back in the UK, can sign separately. So, you know, I think some of these rules are a little bit, we have to be a bit flexible when it comes to property. It's ultimately about the relationship, and it's about how you set up the structures and the accountability within the relationship. That's what is key. The paperwork, the legal side is there to protect you. It's there to provide that framework, but actually it comes down to your relationship and trust. Absolutely. So Rob, with regard to a loan, yeah, it depends how you're going to seed fund that property or that project, whether you're going to make a director's loan into the business, or whether you're going to be borrowing money from the, you know, within that partnership for the business. It depends where the money is coming from and going to. Couple of other things. I would say always take minutes of meetings that you have and share them, even if it's on email. Just take a few notes and write them, because it's amazing how people's memories can change a few weeks after the event, and they thought they heard one thing and you thought you heard another. So always send meetings, minutes of meetings after you've had a conversation. And again, just make sure you each know what your responsibilities are and hold each other accountable to those responsibilities. So this was one of the early projects that I did with Mark in our LLP. So in 2014, we bought this house for £73,000. It was run down, neglected. It had Japanese knotweed, and no one else wanted it. And Rob, I'm sorry, you heard wrong there. You may be living in hope. Thank you, Partha. Yes, quickly moving on. So this was the interior. Actually, after we started the refurb, we put in 3 en-suites upstairs and a loft conversion. And that's the stairs going up to the loft conversion. And this was the loft conversion when it was finished, with an ensuite bathroom and a beautiful finish. And it all turned out to be really, really good. And the kitchen downstairs. So purchased by 73, refurb costs were nearly 60. We spent a lot of money on this refurb, but it was brilliant because it worked incredibly well. Total cost were 131. It got revalued for 170,000 about 3 or 4 months after we'd finished it. So we left in £19,000. Now this money we borrowed from an investor, and I think part of this was what I call a hybrid valuation. This is a valuation midway between bricks and mortar and the commercial valuation, because this is with Lloyds Bank. Our monthly rent is 2,600, outgoings 1,250, monthly profit 1,360, so very good return on investment. However, what I wanted to say was this property got valued about 6 weeks ago for £250,000, and that's in Stoke-on-Trent. So, you know, we bought this 2014, the end of 2014, and it was finished probably mid 2015. So we've had this for about 4 years. And in 4 years, not only have we been making that kind of profit, which we split 50-50, Mark gets 50%, I get 50% of that every month, but we also have made £120,000 in capital increase. We did rent all the rooms before we instructed the valuation. The rooms rented in about 4 days. It was brilliant. And yeah, that's exactly what we did. We made sure it was if you like, a going concern. We made sure it's a business, not just a property. But that, if you imagine, I'm getting £720 a month, probably £790 a month or something from that property, and I didn't put any of the money in, but I did the work. I did the work on this one. So that was the point of the JV, for both of us to make money, and that's exactly what we achieved. So what if I can't raise money from other people? I don't know what I'm doing. Well, let me give you an example of somebody that you know very well. Charlotte. She had no money of her own. She had no property of her own apart from her own home. And she didn't even have any property experience. In 1 week, she raised £150,000 for her first HMO, which is now finished and is now up and running. And she's doing really well managing it. So, Charlotte is a great example of somebody who just went out and did it. She didn't let fear hold her back. She didn't let what other people thought of her hold her back. She didn't worry what other people said. You see, Charlotte was successful because she just did it. She just didn't think about it. She just did it. She had to do it. And I think that's what holds some of us back, is kind of, we're a bit comfortable sometimes. We don't need to do it. But not only that, she has now gone out and formed a relationship with Amelia, who's also in the mentoring group. And this is a different kind of relationship that she's formed with Amelia. So they're best friends now. And you see, the benefit that Amelia has is that Charlotte's in a great investing area, so she can find the properties. Amelia is a good area where she can get great revaluations on her HMOs and draw capital out to reinvest. So together, they've got shared information, shared money, shared time, shared values. Yes, Charmaine, Charlotte from the group, exactly. And they formed this joint venture together. And you see, they get on very well together. They've got family, they've got children. They both understand having other jobs, because Amelia's an accountant, Charlotte's a VA. They're parallel in their direction of travel, even though they're at different areas of the country. And they also have reasonable expectations of what they can achieve and who's doing what. Really good example of a joint venture partnership. And there are others in the group like this as well. Others who have formed, Rob and Brian, they formed a JV before they came on mentoring. And it's even more of a challenge for them because one's in Hong Kong and one's in the UK. And there are other partners involved. So that adds to the complexity of the relationship. That adds to some of the challenges that they have in being able to negotiate those roles and relationships. So how do you make rich people want to work with you? And of course, it's not just rich in terms of money, but rich in terms of resources. So let's bear that in mind. It's not just about money, it's about resources. Can you talk confidently about HMOs and about investing in HMOs? Do you know your area? Do you know what you're trying to achieve? Do you have clarity about what outcomes you're looking to get? Do you know how to stack the numbers? Can you give a deal to an investor or to a potential joint venture partner and say, look, this is what I'm getting? Can you give a case study? And do you know ways of creating that relationship that allows you to get the money, but also allows you to get their resources, gets them on side? Are you able to create rapport in the conversation? Find out about them, think about them, not about what you can get, but actually about what you can give as part of that relationship. So it's about confidence, it's about knowledge, and it's also about having a system. And I'm pretty hot on a system because I think it really makes a big difference to your confidence when you have a system, and it also makes a difference to your ability to transact quickly. I haven't got the time to look for money or find a JV partner. Well, okay. So Keith, he was in the mentoring group a couple of years ago. He still works in the city in London. He has a great job, but very, very long hours. He had little time. He didn't want to use his own money. He had one buy-to-let property before he started to work with me. And the benefit he had was, because he was working in the city with lots of other fairly high net worth individuals, he managed to raise over £300,000 in other people's money for investing in HMOs. And he now has, I think, 3 HMOs in Crewe and Stoke. And that money that he's raised, he's done it within one of them. Sorry, he's done it in 2 limited companies. So he's got 2 limited companies and he's got joint venture partners in both of them. People who are very different from Keith, but are very, very good at some of the stuff that he's not so good at. And he's good at the things they're not so good at. It's really worked well for him. So what made the difference to these people? Well, they were educated, they followed the system to fund it, they used the materials that are on the Google Drive, they spoke to me about it, they had an open mind about doing it. They understood the figures and if you like, the model. They analysed their deals. They were able to really speak with confidence about the finances and the financial side, what the returns were, what the possibilities were, what the market was doing. And they often borrowed credibility from me. So they said, oh, I'm working with Wendy and she's got this and she's got that. They borrowed credibility, and they borrowed credibility from other parts of their lives. The ability to turn around a difficult situation, the ability to run a business as a sole entrepreneur, the ability to have a high-powered job and still invest in property. You know, there's all sorts of things that all of us have that we just look on as just being normal, but other people think they're pretty special skills that we have. So knowing yourself, taking time out to think about what you have to offer to a partnership is very valuable too. So I suppose the question is, what do you want? Do you want to be able to travel? Do you want to be able to quit your job? Do you want to have more time? Do you want to spend more time with your family? You know, if those goals that you set at the beginning of the program are really important to you, if you are prioritizing them, which I believe many of you absolutely are, you're taking action every day towards them, then joint ventures should be something you are open to. Certainly, investor money is key to raising your level of investing. But joint ventures can be a very, very powerful way of doing that because people can introduce you to other people. So the magic 3 is confidence, knowledge, and the system. Know those, and you can raise finance and you can find the right partners as well. And here we are, looking down at you to say, are you going to be next? Decisions determine destiny. So really, I suppose the question to leave you with this evening is, what are you going to do next? Do you feel that you have a bit more knowledge and understanding now about joint ventures, feel a bit more confident about it? Do you want to know more? Do you have some people that you've started to talk to about property, but feel that maybe it'd be worth having a 3-way call with me or Ian to try and solidify it? So, you know, we're here to help you. We're here to grow your business and to push you forward and to get you out of your comfort zone as well. Woohoo!